Yep. How to go, here, but how to go up front now, how to go there, here, but here go, how to go to.
IRS property auctions versus tax auctions. What's the difference? Well, I can start out right away by telling you tax defaulted auctions are local, whereas the Internal Revenue Service is trying to collect on income. So one, they're trying to collect property tax. The other one, they're trying to collect income tax. So I'm Ted Thomas. I've been involved as an investor and a guide in the tax lien certificate and the tax deed business for 30 years. So this episode is going to be a discussion about the difference between a local tax defaulted auction and the Internal Revenue Service auction. As I say, the Internal Revenue is after income tax and have nothing to do with the property auction. So I'm not an attorney, I'm not a real estate broker, I'm not a CPA, so please understand I'm just giving you this from an investor standpoint, and I'm not rendering or giving you any legal advice or direction. That's going to be up to you to get an attorney when it comes time to getting those kind of questions answered. So tax lien or tax deed auctions, they've been around for over 200 years. And all the county's trying to do is collect money so they can pay their employees. So the local government needs money to pay to administrate and manage the county. So the revenue that they get from property taxes is what pays to manage the county. All right, they have to manage the county. It's going to be, if it's a small county, they have a small amount of employees. If it's a big county with a big population, they're going to have a lot of employees to pay. All right, so the local treasurer needs money and they need it regularly. So what do? They're going to charge property tax. But the challenge is, from time to time, certain people don't pay the tax. So what they'll do, if they don't collect the taxes, they'll levy on the property, they'll put it in default, and then they'll auction that property.
How about to go there, how about to go there, how about to go where, how about to go here, how about to go here, how about now, how about to go.
And when they auction that property, they're going to take that money, they're going to take that revenue, and they're going to pay the school teachers, they're going to pay the firefighters, they're going to pay the police department, the sheriff's department, county employees. You're kind of getting the idea. They're going to give some money to the hospital, give some money to the library. All the county bills, and there's a lot of them, all those bills are paid with property tax money. So all that money comes in from the 3,000 plus counties across the United States. All of the counties are a separate taxing jurisdiction. They all have to collect tax so that they can pay the county people. So the responsibility to run the county is given to them by the state legislature. So that means that the county board of supervisors or county commissioners, they have the challenge of making sure that the treasurer goes out and collects property taxes. All right, now the legislature is the one that makes the rules. They do that in the capital city, and then they push the rules down to the Board of Supervisors, and the Board of Supervisors then make sure the taxes are collected. Now, if the tax isn't collected, then they'll put the property in default. All right, now when property's in default, that means that they're going to soon follow up, and they're going to seize and they're going to confiscate that property. And when they do, they're confiscating it with one objective. They're going to sell it at a public auction.
75 to go $100 bid, last call with $100, then all through. Sold to the lady in the front row.
And they're going to start the bidding at the back taxes. That means that property could easily sell for less than 10 cents on the dollar. 10 cents, 20 cents, 30 cents on the dollar. So if you could buy down there at that rock bottom level, you're going to buy a property. Incidentally, the tax collector is going to wipe out the mortgage and the deed of trust. So now you're buying at rock bottom dollar, and then you can sell it for anything you want. I teach people, buy it low, sell it low, and make a profit on the margin between the selling price and the assessed value. So it's not unusual for students to buy properties for 6 and 7 cents on the dollar with no mortgage and no deed of trust. This is happening every day. Why? Because there's so many tax auctions. Over 5,000 tax defaulted auctions every year. Now, we're talking about a local auction, whereas the Internal Revenue Service, that's a federal auction, doesn't have anything to do with a tax lien or tax deed auction. All right, so people get confused about this. They get discouraged. They're not sure what's actually going on. What's really going on is the county is having the tax collector and the treasurer, they're having that property sold at auction. Highest bidder always gets it. So my experience has been, when I started asking other people a lot of questions, I got a lot of answers. And when I got those answers, I started writing them down. There's a lot of decisions to be made, I should say, when you're buying tax defaulted property or when you're buying any real estate. So why not ask people that are already sophisticated and have already done it? You want to ask a lot of questions and write down. I know when I began talking to other people or coaches or mentors, my career just took off and kept going up. So everyone's about to give you advice. Who gives you advice? Young people give you advice. Old people your relatives give you advice. Most of those people don't have any training. So how are they giving you advice about tax liens and tax deeds? So I'm going to suggest that you do it the professional way and don't expect those people to give you good answers, because all of those people haven't taken training, so that advice you're getting might not be very good advice. So most people don't know how to make money at a tax auction. Now, how'd they get it to the auction? Well, they got there because the legislature has already told the county commissioners and the Board of Supervisors they must collect rent. So they send the treasurer and the tax collector out to levy the tax. If the taxes aren't paid, they default the property, and then they end up confiscating it and selling it at auction. If the property owner fails to pay, then they're going to confiscate and sell the property at auction. When they sell at auction, they're going to sell. Starting bid is collect the back taxes. Does that mean the property will sell at that lower price? No, because there's eager bidders out there all the time that will bid them up. All right, so the highest bidder will always win at the auction. All right, now remember, we're not talking about federal liens now. What we're talking about is we're talking local liens on local properties, and the tax collector locally is doing that. Federal liens can remain on the property, but we're not talking about that right now. I can tell you what happens at a regular tax defaulted auction. All the junior liens. What's a junior lien? Junior lien would be any lien that was filed after the original tax lien. Regularly, tax defaulted properties will have other defaults on the property, meaning the mortgage is probably in default or it's probably overdue. There'll also be judgments on the property from lawsuits and other overdue bills. You might even have a state lien on the property. You could have a city lien on the property. If these liens aren't paid, they will be listed on the property file. You see those little white circles? That's how many auctions are taking place within that state in the next 90 days. This calendar updates every single day. I'm here today to show you how to make money. To do that, I'm going to show you briefly that there are thousands of tax defaulted real estate properties across the 3,000 plus counties in the United States. This is quite interesting. You're looking at the Ted Thomas Magic Interactive Map and Auction Calendar. It changes every day. Now, I created the calendar and the map so I would know how many auctions are taking place every day in the United States. Now I can show the little guy how to make money. Most importantly, I created this system so I could have an auction list for each auction 24/7. Now, I've mentioned earlier that the mortgage and the deed of trust lien will fall off the property. It's actually canceled and deleted. Why? Because when a tax auction takes place, it cleans off junior liens. Now, junior liens simply mean that the lien was filed after the property tax lien. So the property tax lien is the priority lien. Keep that in mind. Property tax lien is the priority lien. When this lien forecloses at the tax defaulted auction, all the other liens are going to fall off the property. Why are they going to fall off? Because the treasurer will cancel them regarding the property. They'll still be owed by the person, but those liens will be canceled from the property. Now, this has nothing to do with the federal liens, which are really the IRS and other federal agencies that are trying to collect money on income tax. This does mean that when the property is confiscated by the local county, they are going to wipe out all the junior liens on the property. What is a junior lien? It's a lien that was filed date and time after the property tax lien. Now, the property tax lien is always the first lien on the property. Why is it always the first lien? Because it was filed when the state became a state and the county became a county. They filed a tax lien so that they could pay for the county and have revenue for that county. So that tax lien is filed when the state became a state, which might be 50, 100, or even 200 years ago. So that lien will always be there. Any other lien is a junior lien. And when the auction takes place, all of the junior liens will fall off the property. I'm not talking about federal liens. So you're going to buy a property at the tax defaulted auction, and there won't be liens on the property. They're other than federal liens. So it's very rare to see a federal lien, and if there is one, more than likely it's going to be from the Internal Revenue Service, and there's special ways to get those off. I'm not going to cover those right now. So the only way you can determine a priority of the lien is not the agency, not the amount of money, it's date and time. So the first lien ever on a property is always going to be the property tax lien. Why? Because the day that the state became a state, the county became a county, and that's when the first lien goes on so that they could make sure they paid the county employees. So the rule is simple. First to file and record at the county records is first in place. That does not change. Every document that's recorded after that is junior, and it will always have a date and time stamped on it. Ted Thomas is not an attorney. I'm not a CPA. I'm not an advisor. If you need advice on this, you need to contact a competent attorney that has experience at this, or get to a title company and they'll help you out with that. But I'm not giving you that kind of advice. What I'm trying to do is just give you a basic understanding. Okay, what we're looking at right now is an example. Now, the example is this. All right, let's say the property had a $400,000 value and it had a county tax of $27,000. All right, if the county taxes are not paid, well, then the property is going to be put into default. The treasurer and the tax collector are going to confiscate that property, and then they're going to resell it. And when they resell it, the highest bidder at the tax defaulted auction will get the property. So let's say, for our example, that the highest bidder is $80,000. So that really means that the person that bought that property at auction now has a property with a $400,000 tax assessed value, and they only paid $80,000. Well, you'd like to be that person. However, before they went to the auction, they found out all of these things. That there was liens on the property, $200,000 mortgage, $17,000 medical judgment, a lawsuit for $20,000 that wasn't paid, another $20,000 income tax of the state, a city lien for $10,000, and another $100,000 for the IRS. So there's a lot of liens on that property. But when the auction takes place, all of these liens will be wiped off regarding the property. So that means there was $367,000 in liens against that property. Well, that property owner is never going to come in and pay the taxes. They're just going to let it go to auction. So the owner has no reason to try to save that. But you know, because you went to class and you understood that the liens will be wiped off the property. In other words, the treasurer and the tax collector at auction have power, and they have power to delete those liens from the property. So they're going to extinguish $370,000 worth of liens. And now you have a property that's still valued at $400,000, which you purchased at $80,000. Folks, that's the way the law works. All right, so that's all I have for today. I'll be back with another video shortly. Before I go, I want to make sure that you understand, right below me, you can make a note. You can go ahead and get an auction list. So if you don't know what auction lists look like, you can get a free auction list so you get some idea of how many properties there are for auction. I'll see you on the next video. Don't forget, request your free auction list right below me.